Hey everybody, welcome back to Investing with Wesley. In today's episode, I want to talk to you about what exactly a mutual fund is, what it comprises of, how it works, and that kind of stuff. So with that being said, let's get into it. So for starters, what is a mutual fund? Well, a mutual fund is a type of security that pools individual investors' money together and uses that money to invest in other securities like stocks, bonds, and so on. A mutual fund is operated by professional money managers who use the fund's assets to allocate them into different securities, hoping to generate a capital gain or income for the mutual fund's investors. So that was kind of a mouthful. What exactly does that mean? Well, it means that there is a professional investor behind the wheel of the mutual fund that you're putting your money into. And that professional investor is using your money and everyone else's money is using the mutual fund's assets to invest in different types of securities with the goal of producing a capital gain or income for you, the investor. But don't worry, the professional investor isn't in complete control. The mutual fund's portfolio is structured and maintained to match the investment objectives in the mutual fund's prospectus. And if ever the objectives of that mutual fund change, it requires a vote from all of its members, including you, the investor. So you do have a say whether or not your investment objective can change in this mutual fund or not. One cool thing about a mutual fund is that it gives small or individual investors access to professionally managed portfolios. Now, just like any other ETF, stock, bond, or anything else, with a mutual fund, the investor participates in all of its gains and all of its losses. Now, when it comes to mutual funds, in my opinion, mutual funds add one more layer of risk to the fund, but they could also add one more layer of safety. It really just depends on the experience of your professional money manager. Well, if you have a brand new money manager that has been hired to handle this mutual fund, then they could have very low experience, and thus the assets in your mutual fund and your investment will continue to go down because they might not really know what they're doing. Now, obviously, we're dealing with professionals and not some guy in his garage. But even then, professionals aren't always winners. Sometimes there will be losses in your portfolio, and sometimes there'll be more losses than other investments. So if you had a really good investment manager for this particular mutual fund, then it might be an asset because they could limit the amount of risk and stop losses before they get too bad. Whereas if you were in an ETF or each individual stock, then you would experience the full weight of all the losses. But at the same time, everyone is human, and there could be human hubris involved, thinking that they can beat the market. And as we all know, no one can successfully beat the market long term or consistently. So hopefully whoever the money manager behind your mutual fund is, that they don't have that kind of ego thinking they could beat the market every year, year on end. Because ultimately they're going to lose, and unfortunately for you as the investor, you're going to lose the money, not necessarily the money manager. The money manager makes his money based on the sales fee that is charged to you, the investor. So whenever you're thinking about investing in mutual funds, make sure you read the prospectus cover to cover, and when they tell you who the money managers are and all the other analysts behind that mutual fund, make sure you do a little bit of research on them to figure out who they are and how successful they've been in the past. Otherwise, you open yourself up to not only market risk, because it still is an investment, but also human risk of error. Now, similar to ETFs, mutual funds invest in a wide variety of different kinds of assets. Now, a mutual fund's performance is tracked based on the total market cap of the fund, and this is derived from the aggregate performance of the fund's underlying investments. So as the investments go up or down, so does the value or price of the mutual fund. Now, unlike ETFs, mutual funds have way higher fees. An ETF's fee might be about 0.8% of whatever you invest, whereas a mutual fund might be upwards of 5% whatever you invest. Now, with mutual funds, there are breakpoints where sometimes they charge less, and the more money you give them, the less and less, until ultimately it becomes free. We won't really get into that because this video is to explain your average ordinary investor, not an extremely rich person with millions of dollars to invest. But just know, with mutual funds, the more money you give them, usually the less fees they'll charge. And in order to find the breakpoints of each individual fund and what the next step down worth of fees would be, all of that can be found in the mutual fund's prospectus that they have to give you whenever you're thinking about investing in that particular mutual fund. Now, as a whole, I'm a little on the fence whether or not mutual funds make an all-around great investment, because you could open yourself up to the risk that each individual has of their own ego and the extremely high fees that are charged with investing in mutual funds. You could argue that saving those fees and investing in an index with an ETF will give you better returns for cheaper, and that very well may be true. But I think if you want to invest in very specific things, like up-and-coming tech stocks, mutual funds are probably the better way to go, because you have an entire arsenal of analysts behind those mutual funds that can all read each individual stocks and each individual company's reports and figure out exactly which the best ones are to put in that particular mutual fund. So if you want to invest on a broad scale like the entire S&P 500, then maybe a mutual fund's probably not for you. But if you want to get very specific on what you want to invest in, then maybe mutual funds are for you. Either way, a mutual fund is a great way for you to have a professional money manager work your investments for you. And although they do charge a higher fee than ETFs, if you have a really good money manager behind your particular mutual fund, then it could very well be worth all those fees. But as far as mutual funds go, there's a lot more technical things I could get into, but you really don't need to know them right now. These videos are just supposed to help you understand what a mutual fund is and if you should invest in them. I really hope you got value from this video. I really hope I helped educate you on what a mutual fund is and how they work. If you got value from this video, please remember to like and subscribe because it really helps the YouTube algorithm. Until our next video, have a good one.